In my writings, one of the things that I've stressed is the logic to understand how economic development works to help guide better state policies. I've always likened it to an analogy of baking delicious, yummy cakes and cookies. You start out with some ingredients, you put them in an oven, and out the other end you get delicious, yummy cakes and cookies. Well, economic development is very similar to that. Every economy starts out with some inputs and resources to work with. It's land, it's labor, it's capital, it's natural resources. And, West Virginia clearly doesn't suffer on that dimension. It's a beautiful state, low cost of living, wonderful recreational opportunities, lots of natural resources, minerals, gas, waterways. So we've got all the ingredients necessary to have economic growth. The problem is we're not getting the delicious, yummy cakes and cookies out the other end, which leaves only one problem to be solved, and that's the oven. The oven isn't working. And that's the policies and laws that guide economic activity in the state. One of the other analogies we use in the economics literature is to think about playing a board game like Monopoly. There's the players who play the game, and those are the participants in the private economy. But what the government's main role is to set that rule book, the book that we all turn to that guides us in our decision making in the game. How do we play the game? What are the payoffs? What are the rewards? What are the rules? And it's that rule book that is the equivalent to the oven in that analogy. And getting those rules right and changes to those rules fundamentally change the way people use resources. We see it all in every avenue of life, whether it be the way school children respond to the rules their teachers and parents set, or whether we see basketball players responding to how they change the penalties and foul lines in sporting events. We can see that the rules of the game matter in terms of altering people's behavior. And if we can get the rules better in West Virginia, those resources can be turned into more economic prosperity, higher valued uses, and more income for the citizens of West Virginia. There are a lot of states who've undertaken substantial reforms to try to improve their policies. North Carolina, of course, is a recent role model. In 1 year, it was able to take its business climate ranking from the 40s up into the top 20s with significant tax reform. And I commend West Virginia for taking the step forward to try to do the same. As you know, in most of the business climate rankings, West Virginia ranks fairly poorly, except for ones that are based on the cost of doing business, where you rank very well because it is a low cost of doing business state. And I think that some policy changes are necessary to get economic growth going. Now, one of the things I think is one of the more important points I would like to make today is that there's no magic bullet. There's no one tax that can be reformed that's going to turn things around for the entire state of West Virginia. Economic development and the policies that support it are a three-legged stool. That is, there's the tax climate, but there's also the legal climate and the regulatory climate. You have to have all three working well to support economic development. And if we only change taxes and make those well, but we've still got significant problems in the other areas, the economic development and the impact won't be nearly as large. So while I will spend the majority of my time on tax reform, let me touch briefly on the other two areas. We've got a unique opportunity now in West Virginia to make changes to other areas in addition to tax policy. In terms of regulatory reform, I think we've got a lot of options that one of the advantages of is they don't cost money in terms of cutting taxes and revenue losses. There are changes that can be made to the legal and regulatory climates that are basically free from the standpoint of revenues. In my research, what we found is that different states have different levels of regulation and different quality of regulation. And when we look at what things determine the quality of regulations in a state, there's a couple of policies that really matter, and I want to talk about two in particular. The first is that states with sunset provisions on their regulations do better than states without sunset provisions on their regulations. And let me explain why that's so important. In Unleashing Capitalism, we have an example of a law that was passed by the West Virginia Legislature. The legislature desired to reduce the number of accidents involving taxi cabs in the state. The logic was that people were leasing these cabs for 24-hour periods and they were driving them too many hours a day and were being fatigued and driving too many hours and causing too many accidents. So to overcome this problem, a law was passed restricting the number of hours per day that a taxi cab can be leased to 9 hours a day, 8 hours to operate it, half hour on either side to pick up and return the cab. Well, it was intended, and stated intent of it was to reduce the number of accidents involving cabs on the roadways. But when we look at data, which we present in the book, you can see that the law had the opposite effect. There's actually more accidents involving cabs after the law is passed. To help understand it isn't a mystery, it's just putting yourselves in the shoes of a cab driver who used to have 24 hours to make their daily living. They used to take breaks, eat with their family, go to their kids' sporting events, and drive during the busy parts of the day. Now that same cab driver only has basically 8 hours to make his whole day living. Doesn't take breaks, drives more quickly. And so what you see is secondary effects like that make the policy not work well and in fact have an unintended consequence. There are other unintended consequences like reducing the number of cabs on the road, which means that there's more drunk driving fatalities and it's harder to get a cab home at night from a bar. The reason I bring that up and talk about it at length is this. I argued about that one specific regulation for years and years on the speaking circuit here in West Virginia, and it never got changed. I even said it here, and I'm saying it here again today. And I have a feeling if I go home and come back in 3 years, that law is still going to be on the books, and here's why. If I was to ask one of you why you didn't take care of that, you'd say there's too many more pressing things going on. We have tax reform, we have unfunded liabilities. There's too many big problems for us to go back and reconsider a small taxi cab rule. What sunset provisions do is force regulations to fight to stay on the books, rather than requiring them to fight to get off the books. What a sunset provision does is when you put it into a regulation, it says that the regulation automatically disappears off the books unless it's renewed in a certain period of time. That forces the regulation to actually be in existence so that its effects can be measured, and that after those effects have been seen and measured, somebody has to fight to keep it on the books. And I know that requires more of your time in terms of going back to review regulations, but it's an important step to cull many of the regulations that are on the books that are very ineffective and get some reform. Also, states who subject their new regulations to cost-benefit analysis and particularly fiscal impact statements tend to have better regulatory climates. Some states require only economic cost-benefit analysis, that is, estimating how a regulation would affect the private sector economy in terms of maybe job losses or number of businesses or lost income. But the more impactful thing that we find in our research is requiring a fiscal impact statement. As it turns out, most regulations not only cost a lot of money for you guys to enforce and administer, but they also reduce economic activity, lowering your tax revenues. And ironically, or maybe not, states that require the fiscal impact statements tend to have better quality regulations and fewer regulations on the book once people realize how it's going to affect the state budget to pass these. So those are the two things, sunset provision and cost-benefit analysis, that I think in general could do a large degree of help to get the regulatory system in West Virginia in better shape. Clearly, there's other reforms mentioned in Unleashing Capitalism, things like school choice and voucher programs, and considering a right-to-work law, as other states have done recently, that are things that should be considered and debated. Let me move on to legal reforms for a minute. Maybe a little bit lesser known, but we did a follow-up book to Unleashing Capitalism called The Rule of Law. The one chapter in Unleashing Capitalism on legal reform garnered a lot of attention, and we thought it required a little bit more effort and some legal scholars to help us. Our follow-up book, The Rule of Law, was put together by a team of 20 scholars, mostly legal scholars and economists, to suggest reforms to West Virginia's legal system that could make it more competitive with other states. Not only do we score poorly in business climate rankings, but if you look at the legal climate rankings, West Virginia is near the dead bottom as well. That's interestingly one of the things that this Charleston shares with my new Charleston. South Carolina, too, has abundant ports, natural resources, but it's also one of the poorest states in the nation. In fact, it's the fourth poorest state in the nation, despite its abundant resources, ports, and harbors. But it has many of the same problems that you face, one of which is its legal climate. In the Rule of Law, we outline several legal reforms that could make a big difference in terms of making West Virginia more competitive and having a legal climate based more on the rule of law. In there, we have a debate section where we consider both sides of the debate about replacing the partisan election of judges with nonpartisan judges or a gubernatorial appointment. But the research generally concludes that moving away from partisan elections to remove politics from Supreme Court races and judicial races is a step in the right direction towards making courts work more efficiently. Another one that we discuss at length and have a whole chapter about in the book is to reform joint and several liability, which is how the damages get divided among multiple parties who are at fault in a particular incident. And the current system gives a strong incentive for people to attach deep pocket clients onto small lawsuits, which doesn't help very much as well. We also have some venue shopping problems in West Virginia, which can be solved with meaningful venue requirements. There's also some material in there on punitive damage awards and how to do restrictions on statutory limits on those punitive damage awards, or at least increasing the standard for determining when to award punitive damages. We also have arguments in there on creating an appeal of right and an intermediate appeals court system in the state of West Virginia that could improve our legal system. And finally, a chapter on revising the standard for deliberate intent in workers' compensation cases. Now again, I don't want to take up all your time by talking about things that don't have to do with tax reform. But I need to make it clear that if West Virginia continues to have problems with its legal climate and its regulatory climate, that even though we're playing around with taxes, they won't have as big an effect as if we can get all three legs of the stool working well. And those are some of the suggestions I would offer for things that we should also consider. So let me move on to the main topic, tax reform. When we approach tax reform, there's two basic things that we need to think about. First is, how is the level of taxes? Is the level of taxes good? Are the taxes on general too high or too low? And two, even if the level of taxes is right, are there better ways to impose those taxes that create less economic distortions? That is, to raise the same amount of revenue with less harm on the economy and support economic growth better. So let me address both of those. First, the level of taxes in West Virginia is about middle of the pack relative to the other states. West Virginia is not one of the highest tax states nor the lowest tax states when you just look at overall averages. However, one of the problems that West Virginia suffers is the same as South Carolina. Sometimes being in the middle of the pack isn't good enough when you've got very good neighbors. North Carolina is both of our neighbors, and we have problems there because North Carolina and Virginia and states like that aren't just middle of the pack. They're in the top 10, top 20, and those are the people we're competing against. So even though West Virginia may be in the middle of the pack in terms of its scores for overall tax levels, we're competing with states and neighboring states who have much better tax climates that we should try to compete with, that I think justify trying to move us up from the middle of the pack in terms of the level of taxes. A lot of research in economics suggests it's not just the level of taxes, but the level of government spending that matters. And I would also urge you to consider that overall reductions in the size of government in West Virginia, which transfer resources back to the private sector, can make a better business climate as well. The economic research shows that for every 10% a government grows as a share of the economy, 10 percentage points, it reduces the long-run rate of economic growth by 1 percentage point. So just taking, for example, the events over the last, say, 10 years at our federal level, our federal government has grown by about 10% of the U.S. economy since the 2008 financial crisis. The predicted effect is that the United States' long-run growth is now going to be a percentage point lower than it has been during our lifetimes as a result of that. That's going to make it harder not only for every state, but for the country as a whole to grow and prosper in the future, making it even more important that states try to offset that by getting their policies into better positions. Now, let's talk more specifically about the types of taxes in West Virginia that might be considered for reform. First, going back to the comparisons with our neighbors, I think is one of the more important things. As you know, driving here, it's very obvious what the difference in the gasoline tax rates is. I paid about 30 cents a gallon less for my gasoline in Virginia than I did when I got across the border here in West Virginia. And I'm sorry to say it, even though I love West Virginia, would love to give you my money. I tried to fill up right at the Virginia border and come up here, and I'm going to try to make it all the way back across that Virginia border before I fill up again. Now, I realize that there's a lot of roads in the state that need to be taken care of, and the interstates here seem to get paved more often than interstates anywhere else I've ever lived. And they are adorned with beautiful mileage marker signs that not only mark every 10th of a mile, but have every little on and off ramp now tagged with signs. It seems like every time I come back, we're spending more on signs. If we could find ways to reduce our gasoline tax that would make us more competitive than relative to other states such as Virginia. But at the end of the talk, I will speak more about the links between the taxes and what they fund that I think could give more insight on that. But certainly the gasoline tax rate being higher than the surrounding neighbors is one thing I think deserves some serious consideration. Our unemployment insurance tax rates are 3 times Virginia, but in the middle of the pack relative to all states. That would certainly be another area where if we could find a way to reduce the unemployment insurance tax rates, and I realize there have been steps taken to do that here in the last 10 to 15 years, but continued improvement in that area would be beneficial as well. Now let me turn to our state income tax. The top tax rate in our state income tax is 6.5%, isn't out of line necessarily with other states. One factor, though, is that it begins at $60,000, and the 6% bracket begins at $40,000. South Carolina has an even worse problem than you guys. We have a top rate of 6% as well, but it starts at $20,000 basically. So the problem is we've got a 1959 tax code that was never updated for inflation, and West Virginia essentially has the same problem. What happens through time is that people get richer because of nominal gains, that is due to inflation. You know, if you go talk to your parents about what they made and what things cost, they made half as much as you, but the things that they bought cost half as much. When income tax brackets aren't adjusted for inflation, what happens through time is something known as bracket creep, where people, as their phantom nominal income increases due to inflation, people move up into higher brackets. West Virginia needs to take a careful look at its brackets, at least for its tax code, to make sure that those brackets are where they should be in terms of the neighboring states, and maybe link them more heavily to inflation, so that higher inflation, which I foresee coming in the future nationally, doesn't push taxpayers in West Virginia up into the top tax bracket. In South Carolina, we're in a position now where virtually every taxpayer is in our top tax bracket. Not that the top tax rate's out of line, but it's virtually the only state in the nation where a family of four in poverty is in the top tax bracket. You don't want to end up with the same problem here in West Virginia. One of the reasons state income taxes are important is not only because they affect citizens, but remember that the majority of business income is a pass-through income in the form of LLCs or sole proprietorships, which means that the income tax is actually the business tax applied to earnings from LLCs and sole proprietorships. I do not necessarily think that income should be treated differently. In fact, I believe, and as I'll address later, in a very non-discriminatory tax system. However, I do believe it's important to think about the income tax rates as also the tax rates we're applying to small business owners in the state of West Virginia. Also, touching on other taxes, there are some reforms that could be done for our industries such as forestry. The way our current property assessed values are determined in forestry is problematic with how it discounts future income, and it's my understanding that there are currently rule changes being proposed that will be brought to the legislature in this coming year that help to fix some of those problems about how future streams of incomes are discounted to more fairly tax and assess property values on forest land. However, given that we already tax forest land based on its future income flows, we also then on top of that impose a severance tax based on the value of the timber that's extracted. We're virtually alone in the United States in terms of taxing timber both ways, and I think that's something else that should be considered with industry experts from the forestry industry, given how important an industry that is to our state. While all of these could be reformed to help the state, in my view, the single tax reform that could have the biggest impacts in West Virginia is the property tax on machinery and equipment. And that's really the tax on capital investment, and is where I want to spend the majority of my time speaking today. In fact, the two biggest tax reforms that were in Unleashing Capitalism at the time I wrote it were elimination of the business franchise tax, which I understand is almost phased out. Congratulations. Please keep the course on that. And doing something about the personal property tax on machinery and equipment. So let me go into more detail. Capital is, let me just define it so we all know what we're talking about. So in economics, there are three fundamental ways we classify resources: land, labor, and capital. If we think about any business or anything that's going on, we have the land on which the business is, we have the labor, which are the workers, but everything else is capital. Capital isn't just big machines, although it is big machines. Capital is stuff like a whiteboard in the classroom. It's stuff like chairs, it's stuff like desks, tables, lamps, light fixtures. Everything that's a man-made tool that goes into the production of other goods and services is capital. But clearly, when we tend to think of capital, the most important aspect of that is the machinery and equipment that our workers have at their jobs. That is so important because the productivity of labor, which determines its wages, is driven by the machinery and equipment with which it has at its disposal. Farmers in the United States of America are much richer than farmers in Kenya. And it's not easy, and it's not hard to see why. If you go do a Google image search for a Kenyan farm, pictures will come up. And you know what those pictures look like? Looks like a man with an oxen, with rope and some handmade plow that he's trying to use to farm his own fields. There's workers carrying baskets on their head of the crops that they're picking by hand. You Google image search a farm in America and you see giant equipment, tractors, These giant equipments that can bale stuff, and in a given day, a farmer can be so much more productive with that machinery and equipment. And it's the output that people produce that determines their income. And when people can produce more output and more valuable output, their wages are higher and their incomes are higher. That is, it's capital that drives the productivity of labor, and it's the productivity of labor that drives wages. Going more specifically to West Virginia, let me take an example of the feller buncher, one of my very favorite examples. In the timber industry, there's fundamentally two ways to harvest a tree. One is to have a worker with a chainsaw go around and cut each tree down individually. Not only is it hard work, but it's very dangerous work, and it requires a lot of training. Trees fall in unpredictable ways, and you have to know how to precisely cut that tree so that it falls in the right direction. A feller buncher, if you've never seen it, is a piece of large equipment that has basically tractor treads or tank treads on it. It's got an air-conditioned and protected cab that the driver rides in. And with levers, he's able to manipulate an arm on the front of the machine that has a saw blade at the bottom, a big round saw blade and arms. As it grips the tree, it severs the tree, and he can go around and grip and sever 4 or 5 trees at once, turn them around, lay them in one nice pile for the loader to come harness up and take away. With a feller buncher, a worker can be 5 to 6 times as productive per hour as he can be with a chainsaw. And if you talk to a logger in West Virginia, they'll tell you they're happy the day they get a job with a company that has a feller buncher they operate, because they earn 5 to 6 times as much per hour. They do because they're able to harvest 5 to 6 as much times as lumber per hour with the feller buncher. And not only that, it's actually easier to do than working the chainsaw. It doesn't require any special skills. In fact, it's harder to know how to chop down a tree with a saw than it is to chop it down with a piece of equipment that grabs the tree as you sever it. It's also a lot safer for the workers. But here's the problem. That feller buncher could cost upwards of $1 million just to purchase one machine for one worker to use on a daily basis. It's very expensive. The way property taxes work, as you all know, is it's not just a tax the day you buy your $1 million machine. It's a tax that accrues every single year that you own the machine as a percentage of the value of that machine. So the first year you have your $1 million feller buncher, you're paying property taxes on that $1 million feller buncher, a percentage of it. The second year, perhaps it depreciates to $900,000. Now you pay all over again taxes on the $900,000. In the third year, you pay taxes all over again on that feller buncher, on its now depreciated value. Over the lifetime of the feller buncher, this can amount to as much paying in property taxes on the machine as it costs to purchase the machine itself. What economists have done when they've looked at states and their taxation of capital investment is that they find 2 effects of having high taxes on capital investment. First is it reduces the quantity of capital investment in your state. That means we have fewer feller bunches, fewer backhoes, fewer machines and equipment. And when we have fewer machines and equipment, our workers are less productive and their wages are lower as a result. But second, the incentive exists under higher tax rate climates to hold on to depreciated assets longer. Meaning that is, if you have an 8-year-old feller buncher, you might want to hold it rather than getting the new one that you see that's just come out and is more productive, because if you buy the new one, the property tax stream starts all over again at the high value. At least after it's depreciated, the property taxes are lower. So therefore, high taxes on capital investment both reduce the amount of capital in the state and also result in less productive capital stock, as the average age of the capital stock is higher in states with larger property taxes and taxes on capital equipment. 7 states in the United States do not have taxes on capital investment. And I'll talk a little bit more about that in a minute. But before I do, let me talk about the current capital stock in West Virginia and our tax treatment of it. We have a capital stock in West Virginia, a total capital stock of a little over $50 billion, which, if you look at that relative to our labor force, means the average worker in West Virginia, on average, has about 15 to 20% less capital per worker than the average state in America. That is, in the average state in America, a worker there would have 15 to 20% more machinery and equipment at his disposal on his job than a worker in West Virginia would, giving him a premium in his wages of about the same amount. The capital stock in West Virginia's growth rate has lagged far behind the U.S. average. The U.S. average growth rate has been about 2.3%, and West Virginia's capital stock, after declining by about 0.68%, has leveled off a little bit. But really it lags far behind the growth rate of the United States in terms of attracting new capital investment. And in Unleashing Capitalism, one of the reasons why I put the pictures on the front cover was to inspire this kind of logic. When we look at the big manufacturers and the big manufacturing facilities, we're talking billion-dollar plants and facilities. Look where they locate. We may not have a Fortune 500 company here, but the Luke mill for old West Vaco mill is right across the border in Maryland. It's as close to West Virginia as it can be on the other side of the river. We look over on the Kentucky border. We see Marathon with Ashland right on the other side of the border. We know those billion-dollar investments are no different. There's no difference in the climate or the geography on that side of the river versus this side of the river. The difference is the policies that exist across that river. And I believe that reforms to West Virginia's business climate can and will attract more industries like that to the state. Now let me go into more detail about the current structure of the taxation on machinery and equipment in the capital stock. There are three substantial sources that compare property taxes on machinery and equipment in the United States. The first of which is a study by the Minnesota Center for Public Finance Research that appears in the Competitiveness Red Book published by the National Association of Manufacturers. And it ranks the tax burden on a representative manufacturing business with $25 million of property, which consists of $12.5 million in machinery and equipment, $10 million in inventories, and $2.5 million in fixtures. And they take that hypothetical firm and they locate it in every state in the United States, and they compute what its tax bill would be. The property tax bill on that business in West Virginia would be $833,000 a year, the 14th highest in the United States. More importantly, though, is when we compare it to our neighbors. That same business locating across the river in Maryland would only pay 2/3 as much in terms of its property taxes on its machinery and equipment. If it moved across the border to North Carolina, it would only pay half as much in property taxes. And if it were located in Delaware, Virginia, or Kentucky, they would only pay 1/4 the amount. And again, remember the magnitudes here. We're talking a difference of a tax bill of $800,000 a year versus $200,000 a year for that firm. It's not small change. The second source that I'd like to share with you is a more recent study conducted by the Minnesota Taxpayers Association and the Lincoln Institute of Land Policy, entitled the 50 State Property Tax Comparison Study. One of the reasons I like it is that it contained a more detailed analysis for a wider range of firm sizes. So it had firms ranging all the way from 50,000 in machinery and equipment to 18.7 million. And then it also varied the location within each state that it located, particularly making a contrast between urban and rural areas. So these were the 2010 rankings for West Virginia that I'm getting ready to share with you on industrial machinery and equipment taxes. The hypothetical firm they located in the urban area was here in the city of Charleston. For a firm with about $100,000 in machinery and equipment, they would have the 12th highest tax burden on that machinery and equipment in the nation, even at only a level of $100,000 in machinery and equipment. It would go up to 13th highest, down to 13th highest for $1 million in property, and with $25 million in property would be the 14th highest. So we're in the top 14 in all three, but it's even higher ranked on smaller businesses, meaning it's even worse for them. Now, they located their rural facility in Elkins, in a hypothetical firm locating in Elkins, treated to the normal tax climate. For $100,000 in machinery equipment would pay the 16th highest property taxes in the nation, ranging all the way down to 17th highest for $25 million. That is, no matter whether you look in the urban or the rural areas of West Virginia, we're imposing taxes in the top 20 of the United States on machinery and equipment. The third source I'd like to share with you is Location Matters, which was published by the Tax Foundation along with KPMG. And it compared the tax cost on businesses across all states. My understanding is also that you've had the Tax Foundation here to testify, and I commend you for engaging them. They did substantial work for the state of North Carolina in helping to engineer some of the reforms in that state as well. For a mature capital-intensive manufacturing firm located in Parkersburg, West Virginia, it would be the second highest taxes in the United States, 88% more than the average state, with a total effective tax rate of 23.9%. Quoting now from Location Matters, West Virginia ranks 49 for both labor-intensive and capital-intensive mature manufacturing. Total tax costs are 88% above the national average. The state has the highest income tax burden in the U.S. for capital-intensive manufacturing. Appearing in the Tax Foundation's top 10 list, certainly does not help us attract new businesses to West Virginia, nor help the businesses that are here grow. So again, to summarize, what I think is the biggest opportunity is if we can find ways to reduce the taxation of capital investment. I think that would be the most important step the state could take to try to increase the earnings of labor and increase the productivity of our workforce, leading to a more prosperous state. Again, this high tax rate on capital investment results in less high-quality machinery and equipment at the disposal of workers on their jobs, lower labor productivity, and lower wages as a result. Now, let me turn to other states who've enacted recent reforms and talk about their competitive position in this particular tax. Across the United States, states are lowering or completely eliminating their property taxes on machinery and equipment. 7 states, including Ohio, have completely eliminated the tax. That is, they've set their tax rate to 0. And 2 others are in deliberation, Texas and Indiana, getting ready to repeal theirs as well. That would make a total of 9 states in the United States where you could locate your business and not have to pay those property taxes on your machinery and equipment. Also making it easier for a small mom and pop entrepreneur to get better machinery and equipment and backhoes and machines at its shop. The clear trend across the nation is lowering or eliminating this tax, putting West Virginia at a growing disadvantage in attracting new capital investment if changes are not made to this tax. But this tax isn't harmful just because of its cost and the disincentives it creates for capital investment, but also because of the distortions it creates and the secondary effect it creates throughout the rest of state policy. I believe there's a high link between this tax and the use of state tax incentives. And let me talk about this in detail for a minute. South Carolina is one of the states that actually scores above you in the taxation of capital investment. And South Carolina is one of the most active users of selective tax incentives to lure new businesses to the state. You know, get Boeing or Volvo. When they come to the door knocking, we make their tax rate 0. They don't have to pay those. We do special favors for them. Too bad it's not that way for every firm in the state, instead of just the big politically connected firms. West Virginia suffers from the same problem. In fact, West Virginia has been even more creative in trying to exempt firms from this tax. There are places, at least 2 large major manufacturers, if not more, including the eye-level facility run by Weyerhaeuser in Buckhannon, West Virginia, that were so hesitant to open their facilities with that much capital investment in the state due to these taxes. The state of West Virginia actually owns the land and leases it back to the company because state-owned land is exempt from this tax on machinery and equipment and property. Well, that's nice that we can help a couple manufacturers, and it's good to have them here, and I have no qualms with that. I just wish everybody got treated the same way. If those firms can end up with 0 tax on their capital investment, I think all firms should be able to share in that. But the problem is we create a climate where the tax climate is so bad that firms have to come lobby the legislature or the governor's office to get special tax treatment. And these tax incentives are growing, and West Virginia, along with many other states, gives away a lot of them. There's no good source right now that documents the exact extent of use of these incentives across states, other than one recently done by the New York Times. Unfortunately, it pools all of the tax incentives together, so there's a lot in here that you may not consider as part of that same type of incentive program. But according to the New York Times, West Virginia currently gives out over $1.5 billion in tax incentives, or about $850 per person in the state in tax incentives. It's my belief that eliminating these tax incentives is one way that you can fund tax reforms that apply more broad business climate to everybody, making the taxation of capital investment more fairly treated and lower for everybody in the state. Now, what's the potential of these tax reforms to create economic growth? Well, I'm going to bring to you some estimates from studies done for 2 other states. The state of South Carolina and the state of Idaho have both conducted studies to eliminate their taxation of machinery and equipment. And as part of those studies, models were developed to estimate the effects that it would have on their economy. So let me share those with you and then to see if we can use those to get some rough estimates for West Virginia, the importance of undertaking these reforms. For the reforms in South Carolina, it was estimated through economic modeling that for every $1 in revenue that's raised through the property tax on machinery and equipment, you destroy $1.92 in personal income in the state. That basically means that for every $1 reduction in tax revenue on the machinery and equipment tax, you generate $2 in private sector income. That's a return of 100%, and it's very hard these days to find returns like that, and they do exist, and they exist right here in the tax on machinery and equipment. For Idaho, the effect was even larger. For the effect in Idaho, it would be $3 in income per dollar of revenue. So in both states, the effect is fairly large per dollar of revenue in terms of the economic activity that it destroys. Let's move, though, more specifically to what it's targeted at, which is capital investment. For every dollar in revenue raised through that tax, in South Carolina, $3.37 in capital investment is destroyed. 3-to-1 return. For every dollar you can reduce the tax, it would generate $3 in new capital investment here in the state of West Virginia based on South Carolina. It was $6 in Idaho, twice as much. So basically in Idaho, given the structure of their economy, the estimates were twice as high as they were for South Carolina. Although both of them had very similar estimates for the number of jobs created in both states, it was a little over 2,500 jobs could be created in the first couple of years in both states. Now, if we try to take those and apply them to West Virginia, and I'll stick with the more conservative estimates from South Carolina, to the best of my ability to tear apart the data that I was given on property taxes and isolate just the machinery and equipment component, we're somewhere between $125 million and $190 million in revenue from the property tax on machinery and equipment. Using those figures that we've just looked at, but taking the South Carolina ones, that means that we're currently destroying $300 million in personal income and $525 million in capital investment and 2,100 jobs in the state by taxing capital investment so heavily. And that reforms to this would have the potential to have large increases in personal income, capital investment, and job creation. Again, this isn't just about businesses, this is about wage growth and productivity growth. And using the estimates from South Carolina, one would suggest that reforms to this tax, in fact, complete elimination, would increase household income in the state by a matter of $375 a year. And it'd give the average worker $682 more in capital that they have at their disposal on their job each day to be more productive. So that concludes my part about the taxation of capital investment and machinery and equipment, which I urge you to try to find ways to reform. I do know that it's a challenge to do this, is that the funding for that mostly goes to municipalities and local governments, and that's an important source of revenue for those. And I realize the challenge in any reform to this is finding ways to make up for that and recover for that. Several states that have reformed those have taken interesting strategies, one of which is by basically keeping the tax in place but allowing it to be completely offset against something like the state corporate income tax, meaning that the localities do get the money, the same amount of money that they always do, and the state takes the hit. Other states, I believe like North Carolina, are basically going to create intergovernmental grants to make it up to the local governments. Other states have done things like, one of the things that I talk about a lot in Unleashing Capitalism is the importance of decentralization. Given that there's such widely different economic conditions going on in Morgantown versus Weston and different parts of the state, localities need to have more control over their own agendas, their own taxes. I understand the wonderful things that have been going on in Wheeling, West Virginia recently, and I'd like to commend that city on the efforts it's undertaken to reform its tax and regulatory climate. And allowing localities to have the options, at least, to replace those with, like, for example, local option sales tax might be a way to do this. Local option sales taxes are something that are very attractive in a lot of states because it's a way that they can export their tax burden. Imagine somewhere like Morgantown, where a majority of the residents there on a daily basis are college students from out of state or from different areas, and a lot of out-of-state economic activity goes on there. You know, having a local option sales tax there would be a way for them to raise money that might be able to offset reductions in the revenue they might get from their property tax. Nonetheless, I realize it's a challenge, and I urge the state of West Virginia to try to find ways to overcome that and get the cooperation of the municipalities in reforming that in ways that won't harm their ability to deliver the services that they desperately need for their communities as well. Now, in conclusion, what I'd like to do is back up and take a look at what I would like you to consider as my view of the principles for any tax reform that you undertake, whether it be the tax reform on machinery and equipment or otherwise. To the best extent possible, taxes should be reformed with these 5 points in mind. First, Government works best when it links tax payments to benefits received. One of the biggest problems with government that we've identified in the economic literature, in particular the field of public choice economics, for which James Buchanan won the Nobel Prize in 1986, is that we understand one of the reasons why government works different from the private sector is because in a lot of cases it breaks the link between who benefits and who pays. That is, if I said, you guys can go out shopping tonight with my personal credit card, have fun, how would you behave? A lot differently than you do when you use your own credit card. And when the government breaks the link between the payments people make and the benefits they receive, it's easy for people to want a lot of things that they wouldn't be willing to pay for themselves, as long as they can pass those costs off onto other taxpayers. A lot of economics research has found that the better that you can link the taxes as user charges to the services that they fund, the more efficiently government operates. So let me give you a quick example. Returning to the gasoline tax that I'd mentioned earlier. Certainly we need taxes to fund our road system. The question is, what should you tax to fund the road system? Well, ideally you'd like to tax the traffic on the roads, that is people's usage of the roads, to help pay for the maintenance of the roads. To the extent that you do that, what you're doing is making the people who want more roads and want better roads pay for those more roads and better roads through higher gas taxes. So the gasoline tax is a good tax to have to fund roads and highway systems. What you wouldn't want is a tax, for example, on beer to go to fund the highway system. There's no link between those two things. And that's the point of trying to link the taxes people pay with the government programs they help to fund. So there's a lot of different views of what's fair in taxes, what makes for a good tax, and a lot of people want to talk about equity in terms of horizontal and vertical equity and issues like that. But one of the bigger points that James Buchanan and that school of public choice urges is that one of the better ways to view the efficiency of the tax system is, are people paying for the things that they're consuming through government? Now, certainly for redistribution programs that are aimed at helping the poor, you can't tax the poor to give them money back. But for government programs that do things to the best extent possible, we should do them. If we're going to dredge the Charleston Harbor in Charleston, South Carolina, that should be paid for by the shipping traffic that uses the Charleston Harbor, not by people who don't. And when you don't have links between these two, you get a lot of people wanting lots of goodies provided for them at other people's expenses. And that game gets out of hand, and you end up with government that spends too much and taxes people too much for things that they don't consume nor view worthwhile. So that's number one. Make sure to consider the benefit streams associated with the revenue streams and make sure that they're closely linked. Number two, tax policy should try to be broad-based and not too selective or discriminatory. Broad-based taxes work better for two reasons. First is that they minimize the distortions in economic activity and choices that people make. When we tax things differently, what that does is distort the signals delivered by market prices. It distorts people's usage of capital versus labor. It distorts their choices among different types of economic activity, different products that they consume. And it's those distortions that economists measure when they measure the deadweight loss of taxes. And I'm sure that you guys, as part of your reports, will see a lot of estimates of excess burdens and deadweight losses. Where all those come from are the distortions in economic activity generated by differential taxes that distort the relative prices of resources and goods and services to consumers and businesses and resource users alike. Minimizing those distortions and making sure that tax rates are applied uniformly, fairly, and evenly is a very important step towards having a sound tax system. The second subpoint is that it'll also minimize the amount of unproductive entrepreneurship that goes on. And if you're not familiar with that term, William Baumol, a very famous economist who will likely win the Nobel Prize in the next few years, is responsible for it. William Baumol says that there's a lot of very creative and productive people in the world, all over the world, in every state, in every country. There's a lot of entrepreneurs. The difference across states and across countries is how those entrepreneurs choose to spend their time and talents. Do they spend them in the private sector creating new businesses like Apple, changing the way people live, revolutionizing things, being productive, creating wealth that help us all? Or do they use their time and talents lobbying the political process or using the legal system to try to take wealth from others to enrich themselves in ways that don't benefit society as a whole, but simply transfer wealth around. Unproductive entrepreneurship refers to people like Elbridge Gerry. I'm sure all of you, as legislators, have heard of gerrymandering of congressional districts. The reason it's called gerrymandering is because nobody had thought of it until a man named Elbridge Gerry. He's an entrepreneur. He thinks outside the box. Imagine what Elbridge Gerry could have done in the private sector in terms of something new he could have invented that could have changed the way we live. There's also legal entrepreneurs who find new ways to change laws and enact lawsuits to enrich themselves. You're not alone in West Virginia. In the Charleston Harbor, the biggest yachts are owned by lawyers who found new ways to deliver class action lawsuits and sue people. And there's nothing wrong with people who do that to protect other people who've been harmed. But when you end up with too much of it, you can end up with a lot of the state's resources being drained and driven in the wrong direction. And now that I no longer live here, let me bluntly say that a lot of my favorite people that I knew when I lived here, the most brightest, talented people that I know in this state, are in two occupations where they shouldn't be, in politics and in law. I don't know. Scott Roetruck was one of my best friends, you know. He was great. He was somebody I'd love to work for. I think he's one of the most brilliant people I've ever met. Probably could be a CEO of a Fortune 500 company. But he worked in governmental relations, because in West Virginia, dealing with you guys is an important part of doing business here, and it shouldn't be. Time and talents of people like that should be in the private sector creating wealth. Not to loud out more people, but Roger Sherman, who's here today, is also one of my favorite people in West Virginia. I think is one of the most brilliant people I've ever met. And where I look in West Virginia, when you have brilliant people working for you, where do you want to deploy them to? You want to deploy them to Charleston. Because the state of West Virginia, the government and the legal climate and the political process hold a lot of the purse strings and a lot of the resources here. And the problem with having a tax code that is very selective is that it draws resources in these directions rather than putting them into the private sector where they actually create more wealth than they do here in the state capital. I know that we have a special tax in West Virginia, for example, on soft drinks that goes to fund the Doveview Medical Center. And I remember one time when I came to give a speech here in Charleston, that tax was up for renewal or debate, and I was staying at the hotel here in Charleston. I went down to the hotel bar that night to have a drink, and the hotel bar was filled with two groups of lobbyists. The lobbyists from the Doveview Med School, here to make sure that tax stays in place and hopefully increases it, and the lobbyists from the soft drinks industry, from Coke and Pepsi here. The point is, when you have individual taxes on individual goods, what you do is you draw a lot of resources into lobbying and favor seeking over particular rates on particular goods. This is one main reason why treating all goods fairly and equally, having broad-based taxes, is better. Basically, it minimizes the distortion of resources in the economy and lowers the return to unproductive entrepreneurial efforts. You know, we live in a state here in West Virginia where Girl Scout cookies are exempt from the sales tax, but Boy Scout wreaths aren't. That's not broad-based taxes. I can understand why the legislature would say yes to a bunch of Girl Scouts who were here in uniform asking for a tax break. They might even given you free cookies like all good lobbyists would do. But it doesn't mean that there's a good reason to have that and not also allow other youth nonprofits to have that same tax break at once. Don't make the Boy Scouts come lobby for it as well, and then the Eagle Scouts come lobby for it as well. It's that kind of drawing of resources into the political process which hampers economic growth. So point number 2 is to be less discriminatory. Try to find ways to make taxes broad-based, fairly applied to everybody, and not so selective in terms of treating one thing differently than another. I remember when the Marcellus shale boom was going on and fracking was being introduced here in the state, there was this whole discussion here about what tax rate to apply to it. You know, what Pennsylvania did is they said, look, we've been mining, gas here for hundreds of years. We apply all the same rates and all the same things on regular drilling to this kind of drilling. They didn't treat it differently. It seems like in West Virginia, we want to treat everything as something new and subject it to a whole nother debate about its tax climate. I think make taxes uniform and more broad-based would be a step in the right direction. Point number 3, please don't forget about compliance and administrative costs of taxes. In addition to the revenue burdens associated with taxes, taxes also require compliance and administrative cost. That is the time and effort for taxpayers to comply with these different taxes in terms of time and hours and hiring accountants and estimating things and keeping records. And the administrative cost on government from trying to collect these taxes. In many instances, the compliance and administrative cost associated with a tax can far outweigh any excess burden or deadweight losses associated with the tax. I would urge you to try to find ways to minimize administrative cost and compliance cost for taxpayers, and by doing so, that also frees up resources to go back to the private sector. While not an example from tax policy, one of the issues I've been working on in South Carolina is our system of business licensing. Every little city and locality requires a company that wants to operate there to have a business license. So does every county. Meaning if you live in the Charleston, South Carolina metro area and you're a plumber and you want to serve the metro area, you need over 30 different business licenses to be able to serve the area. You need one for every little small town that's part of the metro area. And it's only to extract revenue, but you have to spend hours and days and record keeping to have a license in every little place. Those burdens on a local entrepreneur are far higher than the burdens in terms of the revenue that they pay for those business license taxes. And the point is in West Virginia, if we look through our tax code, I would urge you to also evaluate taxes based on how much they cost to administer and collect and how much effort it requires taxpayers to comply with those taxes. Point number 4, taxes should count for inflation. I know that you guys may not normally be in the business of using the consumer price index to adjust for inflation on a lot of things, but it's very important. As I mentioned before, when you have income taxes that are set in one year at fixed bracket amounts, phantom gains created by inflation create bracket creep, pushing taxpayers up into higher brackets. Most state gasoline taxes are also set as a per cent amount per gallon, which means that they don't change with inflation as well. As you're updating your tax system, I would urge you to build in some safeguards and provisions that adjust the brackets and rates for inflation, so that as West Virginia moves forward over the next couple of decades, you don't have to have more meetings to reform the tax code again, because those taxes can move forward through time and update themselves as nominal incomes change. Point number 5, and the last principle I'd like to share with you before concluding, is just simply try to be competitive with surrounding states. In any business, it's important to be competitive, because when people are shopping, they compare you to your neighbors and other options that they have. You need to do careful assessment of who you think are the competitors in terms of where you're losing businesses, or where the graduates from West Virginia University are going when they find employment and leaving the state. Avoid having taxes that other states don't have. For example, the business franchise tax was one that most states don't have. Also, West Virginia's taxation of inventory is out of line with other states. Or rates that are out of line with other states, like I'd mentioned earlier, some of the ones on workers' compensation and gasoline tax rates. But I think making the state of West Virginia very competitive with its neighbors is a step in the right direction in terms of trying to reform the tax code. So in conclusion, let me just say, for growth and prosperity, West Virginia needs reforms to all 3 areas: its tax system, its legal system, and its regulatory climate. This is just one part of a long-run process that you're involved in, not a magic bullet. It's an important part of that process. These things are additive. You must undertake these steps in addition to those other steps to create a prosperous West Virginia for the future. But I would urge you, while you have the opportunities to make fundamental reforms in this state, to also consider reforms to the legal and regulatory climates that could go a long way towards promoting economic activity. I appreciate your time and the opportunity to come back to West Virginia to speak to you today, and I'll be happy to use the remaining time to answer any questions you may have.